How big should we all be concerned about inflation? Plus, what do you do when you lose your spouse? Those topics and more coming up on this week's episode of Dollars and Cents. Welcome to the program. We're Central Florida's longest running radio program, coming to you on 96.9 The Game, along with News Radio WFLA Orlando. My name, of course, Joel Garris. I'm a certified financial fiduciary and a certified financial planner with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. Looking ahead to this week, we've got a big conversation coming out of Washington. And Washington is going to be turning its attention to this conversation about taxes. Yes, it's part of the infrastructure bill, but it's also sort of laying out the groundwork for what tax changes we may see in the years ahead. And so it really does break down into three parts. It's going to be detailed in a little bit more detail this week, perhaps, because President Biden is speaking to a joint session of Congress this coming week to outline these proposals. But here's what we sort of know at this point. And it breaks into sort of three different parts to be aware of. First and foremost is the capital gains rate. Now, what's fascinating about the capital gains rate is that it actually changed like almost 20 years ago, and it's at this different rate than income taxes. So if you're in like the 15% income tax bracket or less, so think of a married couple that's making about $100,000 or less of adjusted gross income, you're going to find that your capital gain rate is actually at 0%. For everybody else, the capital gain rate is at 15%. There's another step up to 20% at pretty high income levels like $500,000, that kind of thing. And then north of about $200,000, $250,000, there's an extra Medicare tax that sort of kicks in at 3.8. So you can basically have a maximum tax rate on your capital gains depending upon how much income you have. The highest level is going to be 23.8%. Those are the numbers that you currently pay. That's the maximum capital gain rate. Well, what's been proposed is for taxpayers with income over $1 million. So again, not really a large portion of the population, but for some reason, if you wind up having a singular item, that's oftentimes when we see incomes jump up, is if there's a sale of a business or a sale of a second home or some transaction that happens that all of a sudden jumps up your income. Well, if your income is over $1 million, your new capital gain rate will be 43.4%. That is a significant jump. In fact, an 82% increase in the capital gain rate. So certainly something to kind of really be thinking about. If you've got something that has a large capital gain, how do you ultimately best structure that, particularly with an 82% increase in the amount of taxes that you would have to pay on that? Basically taking capital gains for those with over $1 million and putting it at an income tax rate. Number two is for taxpayers with income over $400,000. So now we're getting down to, a little bit lower level of income, still very high level of income, but for taxpayers over $400,000, you would expect to see that top bracket increase to 39.6%. You would also expect to see your itemized deductions, although this one is not as big of an issue as it might have been in the past, because with the new standard deduction, you wind up finding that most Americans take the standard deduction. Only like 7% still itemize. But there used to be a limitation on itemized deductions that limited your ability to take those itemized deductions, which again fall into sort of 3 or 4 different categories, the biggest of which is mortgage or investment interests, charitable contributions, medical expenses. Some of the other ones that used to exist years ago don't exist, like unreimbursed employee expenses, things like that. Those are completely eliminated from the ability to deduct as itemized deductions. The reality is that when you limit those deductions, this limit would limit them to 28% of adjusted gross income. So if you itemize, for some reason you made a big charitable contribution or something like that in a particular year, had huge medical expenses, the reality is that you would be limited to what you are able to actually deduct to the tune of about 28% of your adjusted gross income. Again, the proposal above 400,000, that's bringing back something that used to exist. Similarly, the top tax rate, 39.6, that used to exist not more than 4 years ago. Again, bringing that back. The other one, though, that is new, that is not a bring back, and that is this notion of a payroll tax or a Social Security tax for folks whose income is above that 400,000 level. You would basically wind up having to pay additional Social Security tax of 12.4%. That would certainly be an increase in that tax bill for taxpayers over above 400,000. And then eliminating the sales and local tax exemption. This is the one that certainly folks in places like New York and California want, because right now the ability to deduct that, assuming you are itemized, which again is only like 7% of the population, the ability to deduct that is limited to only $10,000. The thought is to remove that cap and ultimately allow people to deduct the full amount of their real estate taxes. So that's category number 2, taxpayers with income over 400,000. Number 3, of course, is corporate tax rate, increasing current law 21%. The proposal up to 28%. That is a 33% increase in corporate income, corporate tax rate. Just again, for comparison purposes, it used to be 35 not more than 4 years ago. So not quite back up to the level that it was. But again, a lot of these proposals that are on the table, with the exception of that excess payroll tax, and of course the much higher kicker on the capital gains, those are new concepts. But a lot of these are reverting back to where things were just a few years ago. So as investors, well, set aside being an investor, how about just somebody that is trying to retire, educate their kids, and ultimately buy a house or something like that? Just general folks. What's the things that you need to be thinking about in terms of that backdrop? Well, here's the impact. We think there's 2 major impacts. You're going to have to really make sure that your investment strategy and your tax strategy and your estate planning strategy are fully integrated. There's no way to think that you're going to be able to separate out each of those functions with that level of tax changes. And we're seeing that even now this year, where we've got, as part of our team, an IRS enrolled agent and CPA as well. And the integration that comes with the tax preparation and the tax analysis and the investment side and the estate planning side, it is more than it ever used to be. A significant shift, just based not just upon things like stimulus checks and unemployment benefits and things like that changed here at the 11th hour, but just thinking back even to the Secure Act and what that did for retirement accounts to your beneficiaries, where they've now got to take it out over 10 years, where before they could take it out over the rest of their lives. That's a pretty significant difference and a real opportunity with the right planning to be able to sort of address that tax side of things. So got to make sure that your tax, your investment, and your estate planning strategy really is fully integrated to really make that all come together. And then number 2, specifically about the corporate tax rate, really watch the earnings. It's the consensus expectations are that increase in corporate tax rate will effectively wind up being an 8% hit to the S&P 500 earnings due to that higher taxes. Now, there is an expectation that that's going to be somehow offset by about a 4% boost in revenue due to fiscal spending. So the one issue that folks are going to need to be looking at is, what can a company do to minimize that hit on earnings? And at the same point, what can a company do to sort of maximize that boost of earnings? So those are kind of stats to see more of an outline, if you will, in terms of the changes that are expected to be rolled out on the tax side of things. Just some initial thoughts on what investors need to be looking at and need to be focusing on from a investment or simply a savings perspective. So just give you some thoughts on that conversation that's going to happen in Washington this week. As always, we'll keep you posted on those kinds of things along the way here on the program. We're going to slide to a break. When we return, we're going to talk about what happens, what you need to do when you lose your spouse. All that and more coming up on this week's program. Inflation. Beginning to hear more about it. What is it? What's the impact? And more importantly, what's the solution for investors and retirees alike? Certainly, there's been some interesting readings of late on inflation that would suggest strongly that you may want to be concerned about it. So welcome back to the program Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here on 96.9 The Game, along with News Radio WFLA Orlando networks. We also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So be sure and subscribe to us on your favorite podcast channel of choice, or you can check out our YouTube channel under Nelson Financial Planning. Well, you'll see videos of the program along with other videos that members of the team do during the course of the week. So my name is Joel Garris. I'm a certified financial planner, certified financial fiduciary. Speaking of that team at Nelson Financial Planning, we've got a team of certified financial fiduciaries that stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides peace of mind for the future. So what's inflation? I think we all know kind of what inflation is, right? It just means that the cost of stuff goes up over time, whether you think a postage stamp, although people don't use postage stamps anymore, but they send an email. But a gallon of milk, whatever the case may be, you know that 30 years ago you paid equivalently less than what you do today in terms of the absolute amount that you pay for that item. The fact that the amount of dollars that you pay for that is increased, that is in fact a perfect example of inflation. And so ultimately, with that example, what inflation does is it reduces your purchasing power over time. And you may not see that from one year to the next, but over an extended period of time, I mean, think back, 30 years ago, how much was a stamp? How much was a gallon of milk? The reality is that inflation can, in fact, be one of the biggest problems in retirement, particularly for the average couple retiring today, mid-60s. The odds are pretty high that one of them may very well still be alive 30 years from now. So the impact of inflation over a 30-year period of time is estimated to reduce your purchasing power by about half. That means at 95, you can only purchase half of what you could purchase at 65 with the same amount of dollars. Well, you certainly don't want that level of a surprise coming to you later on in your retirement years. So that's a significant issue that you need to be considering when it comes to inflation. If we take a step back and sort of look at what's going on currently today, well, we've got a Federal Reserve who is saying that they're not going to raise interest rates until 2023. Now, understand the biggest reason why the Federal Reserve raises interest rates is when inflation winds up being higher than what they expect. They use interest rates to help monitor the level of inflation. Well, they've already committed to the fact that they're not going to raise interest rates, which is what you would typically do to offset inflation. They're not going to do that until 2023. So that's like still 18, 19 months away at the earliest. But unfortunately, if inflation kind of pops up, that may force their hand. So let's take a look at the latest inflation data, shall we? This should catch your attention. This is from the Bureau of Labor Statistics, which is the government entity that puts together something called the CPI, the Consumer Price Index. That's how you measure inflation. And so for March of 2021, so this is last month, inflation, or the CPI, was up 0.62% for the month of March. Now 0.62, that doesn't sound like much, but remember, that's over 1 month, and inflation is measured, and they're looking to keep inflation at 2 or 3% over the course of a year. So you can see where, wait a minute, that number seems like that's a little bit higher than what it should be, and in fact, it certainly is. The 0.62% CPI for the month of March was the highest recorded rate since June of 2009. And in fact, for further perspective, if you look at the last 30 years, so that's 360 months, 30 years, 360 months, there's just been 6 months where US inflation for a single month has been over that 0.62% threshold. So that was a significant number to kind of start to watch. Inflation is certainly real, and the mainstream media is missing this little detail, particularly when you look at the number that was generated for the month of March. So what's the impact? Now that we got a data point that says, well, wait a minute, maybe there is something going on with inflation. Well, could force the Fed to start to raise rates faster than expected, which may have certainly some shorter term impact in the market, in the economy, but let's talk long term. What are the impacts if inflation does come back at a higher level than what we've seen over the course of the past 10 years? What's the best hedge against inflation? Well, my apologies to all the gold lovers out there, but that's not it. Prior show, we've talked about the returns on gold over time. The reality is that gold over time, 25 years, which again is what we're talking about, right? Because 30 years in retirement, how do you offset the impact that inflation just in normal times is going to have? It's going to reduce your purchasing power by 50% during the course of a 30-year retirement. Okay, fine. Let's look at gold over the past 30 years. It's a negative return. It's not the answer. The answer is the old tried and true, which is the best performing asset class. When you look at all the different asset classes, stocks, bonds, gold, cash, say it is in fact stocks. Stocks continue to be, and owning stocks and equities in your portfolio continue to be the best hedge against inflation over time. So make sure your investment allocation has a heavy dose of that if you want to hedge against inflation, particularly on the larger company side of things. Why? Because simply put, the larger companies have the ability to pass that increased cost on to consumers. So ultimately, they've got a little bit more flexibility and a little bit more freedom to say, okay, things are costing us more, so ultimately the cost of our product is more. And if you're a large company, chances are people still need your product, and so consequently, that's why stocks historically have been the best hedge against inflation. And certainly you may sit there and say, well, wait a minute, stock market's at an all-time high right now, and so very concerned about the potential for volatility. Shoot, just a year ago, markets went down in a bit of a free fall when news of the pandemic first started. Here's the reality, and I think here's the reality that we forget about stocks and the stock market. Stocks are often at or near all-time high. Stop and think about that. When you look at the history of the stock market, it looks like a gradual slope up a mountain, which means then that pretty much on a regular basis, it goes on to set higher highs. According to Bloomberg, if you look at the S&P 500, and when it is at a price level that is within 5% of its last all-time high, okay? So you're looking at the stock market, you're looking at where the level is, and you're looking at the market within 5% of its all-time high or at a new high, you will find that that scenario, in fact, is true 43% of the time, going back over the course of the last 70 years. So, to get this straight, this is kind of an interesting little stat, right? Since 1949, the S&P 500 has been at or near its all-time high 43% of the time. Let's not get too fixated on where the market is. Let's remember that when you're investing and when you're planning, you're talking about 30-year type of time horizons, because that's what you're fighting against. The power of inflation over time, the power of inflation that reduces your purchasing ability as a retiree by 50% during the course of your retirement. So if you want to hedge against it, the best hedge historically, don't get too caught up in where the market levels are one way or the other, but the best hedge against it certainly is owning stocks and stock mutual funds. With that thought, we will take a break and continue on with the program. Coming up next on the program, we'll talk about some of the things that have changed in the world and have affected what you have to deal with here as from a financial perspective. All that and more on Dollars and Cents with Joel Garris. The world has certainly changed over the course of the past 50 years. Think back, right? No cell phones, no internet, no emails, no Amazon, for crying out loud. There's been a wide range of financial problems as well that just didn't exist and you didn't have to really worry about 50 years ago. And today on the program, we're going to talk a little bit about some of those problems and the solutions that you can have to these real issues that exist today that are more important than ever before and frankly didn't even exist 50 years ago. So welcome back to the program Dollars and Cents. We're Central Florida's longest running radio program, coming to you on the News Radio WFLA Orlando network along with 96.9 The Game. Be sure to check out our podcast channels as well. Just search for Nelson Financial Planning on your favorite podcast channel of choice, whether that's Spotify, iTunes, or what have you. We are there and we've got a podcast just for you, along with our YouTube channel at Nelson Financial Planning. My name is Joel Garris. I'm, of course, with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan, and one that tackles some of the things that exist today that simply did not exist 50 years ago. Chief among them, 50 years ago, you didn't have to worry about fraud and identity theft, right? I mean, that was not anything that was on anybody's horizon. Nowadays, it's unfortunately relatively commonplace. We heard an ad even during the course of this show talking about how to protect your information, and that's really part of the solution, right? You've got to protect your information. You've got to shred your documents, just simple stuff that you need to be doing to make sure that you are protecting that information. Again, stuff that you didn't have to do 50 years ago, but certainly shredding your information, which is why our office holds shred days on a regular basis for our clients. In fact, we got one coming up here in about a month or so on May the 25th. Not just paper shredding event, but also a collection of computer equipment as well, where we have folks on site that take out the hard drives and stuff like that and crush them, make them completely not usable, and then ultimately recycle the rest of the equipment. So those are the kinds of things that, yes, you've got to do, is kind of going around the house sort of preparing personally for our next shred day on May the 25th, particularly with the computer equipment. And I found a couple of laptops and an old desktop, and so important to not just throw those to the curb, because there's a lot of information on those hard drives. So you need to kind of go through that process of making sure that you're protecting your information. And then, of course, speaking of computers, make sure you update your computer when it comes to downloading the newest version. All too often, those older versions are just that. If they haven't been updated, then you're making yourself much more susceptible to identity theft, computer theft, phishing, and all those kinds of things. Number two, 50 years ago, you didn't have to worry about credit card debt, right? In the 1970s, only about half of American families had one or more credit cards, and the most common type was a retail store card. Today, almost 8 in 10 adults have at least one credit cards. Credit cards have become increasingly popular and really sort of the norm for spending, but it can also be much easier to overspend and not realize it. So the solution's there, right? You've got to avoid that mentality of sort of spending now. Another good option is to use a debit card, because that takes money out of your account instantaneously, so that you know exactly how much money you've got and you're not losing track of how much you are spending. But obviously the credit card issue, massive issue for many Americans, and one that didn't exist 50 years ago. And unfortunately, it's just too easy to wind up using those credit cards and not realizing how quickly that can get out of control. And then with the interest rates that they charge, it can really spiral that pretty dramatically. Number three, well, cost of living, right? We were just talking about that in the previous segment. That is inflation. The fact that 50 years ago, okay, families could make it on one income. Today, most families, it's two people working. The cost of stuff is higher. That is inflation in a nutshell. And as we were talking about in the prior segment, the solution, of course, is that you've got to make sure that your investment allocation, your allocation to the stock side of things, is as significant as it needs to be in order to offset inflation. Also important to sort of keep track of expenses along the way, right? That's a good idea, to figure out ways in which you can kind of reduce your expenses and help to offset the higher cost of living that exists today that didn't exist 50 years ago. Similarly is this notion of online impulse purchasing, right? The whole need it now mentality, keeping up with the Joneses. I saw where on Facebook they wound up getting a new car or went on a beautiful vacation or something like that. You've got to keep up with them. And ultimately, that's the impulse purchases that can quickly get out of control. So the solution there, stay off social media, right? That didn't exist 50 years ago. It's in some ways a shame that it exists now, because it makes it all too easy to get into this comparative trap that we all find ourselves in, where we're like, oh, well, they're doing that, then I want to do that. And ultimately that can lead to a pretty significant disruption in your finances. Childcare costs are another one that certainly are a greater issue today than they were 50 years ago. Of course, more women in the workforce, but that also means that there's more of a need for childcare. So that average weekly at about $215. Lastly, student loan debt, right? No surprises there. That didn't really exist 50 years ago. Make sure you're taking advantage of community college options and think through the cost-benefit analysis of what type of school and institution you're going to. So those are some of the things that did not exist 50 years ago, but do exist now, that are creating a whole host of financial problems. We've outlined some of the solutions very briefly, but if you want to listen to it more, double check the podcast on our podcast channels. This has been Nelson. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando.